Talk about a glitch today. What a funky trading day we had. My name is Michael Silva. You're watching the Daily Stock Market Brief. If you're wondering what I'm talking about when the SPY all of a sudden spiked up to about 378 and an order got filled and then spiked all the way back down. Very crazy stuff. It was like a fat finger sort of trade sort of thing going on. Hey, maybe that's telling us that's where the market might be headed next. In today's video, we're going to be looking over multiple asset classes. We're going to be looking over the stocks indices, right? We're going to go over some indicators, commodities, the dollar, the bond. I'm going to wrap everything together with a conclusion, kind of where my thoughts at going into the end of the year. There's a couple things that are kind of showing the signs for a potential short squeeze even higher right now, and I'm going to be talking about that. That's that whole holiday rally or Santa Claus rally, whatever you want to call it. But then there's also definitely storm clouds off in the distance, so we need to be still very careful at these overextended levels. Let's go ahead and get into today's show. All right, welcome back. Yes, stimulus passed. $600 for some people, right? Woo! And then also what took place? Well, look at the financials up here leading the way. What was said about the stress tests that the Fed did? And then what did they say shortly after about being able to do share buybacks? Of course, they're going to catch a bid here. They're going to start moving up. So yeah, the top performing sector was financials. You can see real estate there at the bottom, next to utilities and next to energy. But I'm going to be talking a little bit more about utilities today. Not in great detail, but this is interesting stuff that I have to show you. And then you can see it's red across the board, but look at these down numbers. It doesn't show much, right? So if anybody that, just is a passive investor, they look at, at the end of the day, maybe, or the end of the week, and they just say, well, it was only down 0.19. No idea as to what actually took place today with some crazy chop back and forth. Let's go ahead and hop into the indices. We're going to do that, then get into the indicators, and then move forward from there. Daily time frame of the S&P 500, the SPX. Look at just huge gap down. Now, it didn't look like this was going to happen on the news with stimulus, but then later on in the night, the futures market completely rolled over. I remember randomly pulling it up, and it was down about 500 points. Absolutely crazy. But what took place during the cash markets? Well, look at this. It's just a big hammer candle. Hammer candles are typically candles that follow through with bounces. So if we get a break above this previous high, there's no reason why we can't continue this move higher. And that's that whole Santa Claus rally. And I have some indicators to help kind of confirm that potentially. But overall, we're still, just look at this chop from beginning of December. So for 21 days, we're really just going sideways right here. We're up slightly. And then this last trading day was just, look where it came down to, right? We pulled right into the level of support that we drew out right by the gap. We were talking about this being a level of support if you were to be able to buy into that area. Well, it looks like, not only algos, but a bunch of, buy the dippers came right in right around here, and boom, we bid up the price all the way back up. Note, we're still below we're now again once below the 5 EMA. And what have we been saying about that? That's how you can see a short-term trend change. However, we've been getting below the 5 EMA and we haven't been staying there that long. 30-minute time frame, yes. This bounce came off right here. You can see the RSI got oversold readings, and then we saw that bounce. That makes sense. We're still really within this channel. I'm not gonna take away this channel at this particular point in time until further notice. We have a little bit of a gap above us. That was from the gap down, and then there's still a target right around here at 37.50 and potentially even higher if this big bounce right here continues. But there's nothing certain at this particular point in time. So we're just going to have to watch these specific levels. Levels to watch on the S&P 500 is this gap below us, so this 36.40. The low of the day was 36.36. Let's just call it 36.40. So if we start breaking through that, that means in the short term, we're going to be making lower lows. Now, we pretty much tagged this one. And what we said previously? Well, if we start making lower highs, that's one sign, but you also have to start putting in lower lows, and then that could be that slow potential shift from just this relentless rally up to maybe potential more downside. I want to remind everybody here to go ahead and smash that thumbs up button. It does mean a lot to me. Thank you if you do. Woo! Dow Jones. Daily time frame. Rising wedge pattern is still holding. Okay, we came down today. It looked pretty nasty, but look where the lower Bollinger Band was. We had some gap right here, some gaps that could have been filled. There's a lot of support within this range, and then we got this price bid right back up. Look where we are. Where did we get jammed right back up to? Right above the 5 EMA. It's almost as if they're all like just algos are just watching the 5 EMA right now, and they're constantly just putting the price right back above it. It's absolutely incredible. It did come below the 20 period, but everything right there is still holding a support, continually coiling up in this pattern. This is the resistance line that we really want to keep an eye on. 30,400, 30,500. The more days that go by, this can drift higher and higher. So we got to be cautious of that, because if we start breaking above it, that can really show us just a potential very big blow off top, even bigger than what we've seen right here in early November. So be mindful. I drew out the 30-minute time frame to just be in this channel now. Look, we have a little area of support right here at 29,800. It's been going sideways pretty much since, since the beginning of December. And you can even go back a little bit further. So maybe late November all the way till now, it really hasn't done anything. So this has been just chop back and forth. And we've been talking about that. It's frustrating for anybody that's trading this, because it's just literally the volatility is kind of, a little bit here, a little bit there. But it's really just been this chop. And it's very hard to position yourself. So we got to look at key levels. If we pull down to here, 29,000, hey, that could be a good area for potentially do a buy the dip, and then you see a bounce from that point. But make sure you have stop losses. Or if we start squeezing above this 30,400, we might see even more of a pop. Now, what I want to really point out here on for the Dow Jones, while I'm going through the Dow Jones, is the transportation index. Now, this is the monthly time frame, and I've been talking about this. This is a candle to watch out for. Now, this is a shooting star. Right now, it's a bearish doji, or gravestone doji, they call this, after a big bullish move, and then you get a candle that looks like this. Now, going into next month, if we get a confirmation or a move below this, we got to be very careful. If we get a monthly close in January, monthly close below that, we're poised to go ahead and just tag this 5 EMA. That would make sense. Now, next month, the 5 EMA is going to come up a little bit. So that could be around 12,000. And keep in mind, we have resistance, 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 resistance. So once support is broken, it then becomes, once resistance is broken, it then becomes support. So if we pull back into this area, then we might continue this rally. So you could potentially, if you're a buy the dip, mentality at around those levels would make sense. Just make sure you're holding on to your stop losses. Now, at the beginning of this, I said I'm going to talk about utilities. I bring up this chart every once in a while. This is the Dow Jones Composite, and it's made up of these three charts right here. Well, charts, indices. And what it is basically the transports, the industrials, and the utilities. Now, these should all move in unison together. But what I want to call out here is utilities has been diverging for quite some time now. You can see that it has not made an all-time high, but the industrials have, the transports have. Now, the utilities is only made up, I believe, of 15 stocks. So this is relatively small comparatively, but keep in mind, when things diverge for months weeks or months at a time, it could be a sign that there's some underlying weakness here. So we got to be very careful. And then when I'm looking at the monthly time frame for the transports and the overextensions in the industrials, everything is kind of saying, hey, we're not too far away from a potential correction or some just increased volatility. So be mindful of that. Now let's quickly go through the Russell, the one that has been just ramping higher and higher. So to build out context, where are we to the 5 EMA? We're 14% above it. Completely extended, nothing like this in history. Go ahead and look through the chart. You won't find it. The PPO oscillator, this is at a 110 if you want to make this on a chart. It's super overextended. The last time that it was even remotely close to this level was these 2 points right here in 2010 and 2011. And you can see when we get to those levels, we have some pretty aggressive moves to the downside. Now, we broke out of this resistance. See right here, resistance, resistance, we broke out. So this move can continue. Now we are overextended. Maybe we pull back to the 5 EMA and then retouch this level of once resistance is broken and then become support. That's right, puts us right around 170, and then we can see a continuation move. That would make sense to me if we start seeing some aggressive moves in the market. Now, it's important to note this. If we start seeing moves from the price from where it's at now down to 170, that is very, very aggressive. You're going to be hearing news lines all throughout the media that everything's fallen apart. And just like you're hearing today that everything's going like amazing, you got to understand, that's why you need to know these levels, because you can't just listen to headlines. These levels have already been mapped out by plenty of other people and plenty of other traders and probably plenty of algos that if we pull back to these levels or reconnect with the 5 EMA, we're going to have buyers stepping in. So if you're a short-term trader, Make sure you're aware of it. If you're an intermediate term or swing trader, make sure you're aware of it. And you can just have stop losses below those levels. It's as simple as that. Daily time frame, we broke out of the rising wedge, immediately got bid back up, 33% above the 200 period moving average. Once again, historic times, okay? Overbought in the RSI indicator as well. MACD, we're way up here, but it's been just really kind of just dying off right here. It looks like it's trying to roll itself over slowly but surely, probably into 2021. So we'll see here, obviously, what pans out. More interestingly is the 2-hour time frame, just this impeccably perfect rising wedge. I've been saying if it breaks down fully, we're going to look back at this and be like, it was so obvious. Well, we had this huge gap down, immediately got bid back up. We closed one of these gaps right here. I got to get that removed off the screen. You see the punch nail right here. You see that big red day, and then we gap down through the rising wedge pattern right here, and we got big back up. So this is okay. This is still a technical breakdown, or breakout of this rising wedge. So we can still move up higher, but that doesn't mean that we won't see chop back and forth if we see a continuation to the downside, okay? So also be mindful of that. Where can this pull back to? I would just say look around 180 to 170, this kind of target area right in here if it does see a continued breakdown. If we start seeing a rip higher, we can easily go 200, 205, that range, and still be kind of following this trend line that we just broke down from. And then here on the 15-minute time frame, I wasn't shocked when we saw that rip up, and the reason why is because we gapped down. Okay, we're pretty much already oversold, and then we gapped down this morning. We woke up to a big gap down, and it was extremely oversold, and immediately, pretty much immediately, an hour into the day, we relentlessly just jammed up higher and higher, bull flag, and now we're starting to break above that. We closed that gap from the day as well. So yeah, we have some resistance here, and we put in a lower high, and if this gets broken, we might see some new lower lows put in place tomorrow or in the near future. But we got to keep an eye on this is support 91.50, and this is resistance 197.75. That's the IWM. All right, let's look at the NASDAQ. I'm only going to show the daily time frame. This actually move kind of made me realize, okay, this actually might be a rising wedge pattern as well. The MFI down here, the money flow index, keep in mind, just notice how the pattern was a symmetrical triangle when we broke out. The money flow hasn't done that, and the money flow actually headed lower today, and that could be because of the gap down, so that would make sense. We got to see how this one plays out, but if we start seeing a continuing draft here as this is drifting up, that's a negative divergence between the MFI and the price action on the NDX. So the move's getting higher and higher, but the money is flowing away from it, so it's just moving higher on weaker strength. Now let's look at some indicators. This is where it gets a little bit interesting, okay? This is the case for the Santa Claus rally. I posted this on Twitter. If you don't follow me there, you can follow me there, or follow me on Instagram for some random stuff. I do plan on posting more content there in the near future. So first off, what do I want to point out? Notice how it's curling back over pretty sharply right here above the blue line is going to cross back above the 10-period moving average. That should happen here by tomorrow, most likely, or the next day. Doesn't mean it got to stay there, but it looks like it's doing that. Now, the last time that it closed at this -10 or above the -10 and it curled above it, there was 2 times right here, and then there was some more down here. But look at what happened the last 2 times this little cross happened, okay? Boom, we had this huge squeeze up to the upside, okay? And then right here, we crossed above. Boom, huge squeeze to the upside. Right here, not a squeeze, but we did ramp up higher. Right here, it actually went down a little bit and then continued higher. Why am I pointing this out? This is the Pring bottom fisher. It finds bottoms. Now, we just, on the NDX or the SPX, we just made a huge hammer candle, and hammer candles typically are bounce candles. So if we start crossing here and we start getting above the high of the previous S&P 500 candle, that hammer candle, maybe that's telling us, hey, that glitch that we talked about at the beginning of the episode might bring us and squeeze us higher to that 378 range that was printed randomly on the SPY today. So that could put us at over 3,700 or 3,750, 3,760, that range, 3,780 potentially on the S&P 500. So, that's just it's not a prediction. I'm just saying, hey, don't be shocked if something like that does take place. But there's also some concerning things too. Here's the sell signal. We're moving closer and closer to the red line. Once we cross above that, that's the sell signal. We can see some weakness take place in the markets. Sentiment has been extremely bullish, and now we're starting to see the moving average move to that line. Now, when we crossed above it previously, look at right here, we went up just a little bit, and then we moved down. We crossed above it here, what do you know? Well, first off, we're already down. We went up, sideways, and then down further right here. We went sideways and then down a little bit right here. Quick hit. Boom. That was that big one. And then right here too as well, we went down. So it's been pretty accurate so far. So be mindful that when this crosses above, it doesn't mean go buy puts, but it says, hey, if you're extremely exposed to the long side and exposed to a bunch of risk to the downside, you might want to, pedal back a little bit here. The VIX, we broke out of the falling wedge. That's bullish, huge move that hit the target of the 2750 that I've been talking about. And then went even higher than that, and we were quickly rejected down. We're still above this, and we're above the upper Bollinger Band. Remember we said when they contract very tightly like this, and we pointed out these, we see some aggressive moves to the upside so far, or at least the last 2 times here and right even here. Well, guess what? That was that aggressive move. And we broke up. Now, this is somewhat of a shooting star candle. Maybe we start drafting lower, or maybe what we've seen previously when we break out of rising wedges on the VIX, sometimes we travel lightly down, and then we start continuing that volatile move higher. And that's a very big possibility here, given the current candle and how it looks. RSI is above 56, and it was a big print for the day. So a lot of volatility today, but the market clearly started coming back as soon as this started dropping down lower. Overall, when we look at breadth, this is the NYMO. We're printing minus 21. So yeah, pretty gnarly breadth print right there, but it's not by any means overextended to the downside where we can say, okay, it's going to bounce from this point like we did when we called it over here on these dips. So that's also something to take note. Now, if we all of a sudden get a strong breadth to the downside, that might be saying to us, oh, okay, well, that's a little overextended. Maybe we can potentially start hedging long right there. And then we look at the NYSE. This is the fast stochastics on the NYSE. I learned this one from Sven Henrik. This has been maxed overbought, and this can stay maxed overbought for quite some time, but notice it's starting to roll over right here. Now, that's okay. Once we start seeing it cross back down, then you could probably see some more selling pressure. Keep in mind, like, you can see crossovers and it comes right back up and then so forth. It can last like this for weeks or even months. But it's just telling us right now from a weekly perspective, be very tactical when it comes to placing long positions. Now I want to show you 2 other indicators. First off, we're going to go through the lumber and gold here shortly, but let me show you the XLU over the SPY rate of change. This is also coming from a white paper from Michael Gayed. I interviewed him. If you haven't watched that interview, you can watch it. It's pinned to my Twitter account, and also it's like one of the main videos on my channel. So this one, however, is looking at he calls this the beta rotation strategy, and it's basically going from high beta to low beta. And how he does that, or how he looks at it, he looks at utilities for the lower beta. We talk about low beta being utilities, and that's kind of when utilities start upticking. That could be a potential risk-off play. Well, when the rate of change, we're looking at a 4-week rate of change, when it's below 0, that means that you want to position yourself long more beta, which is the S&P 500, when it's below 0. However, when it's above 0 the following week, you want to start looking at risk off, which is utilities. So notice right now it's saying that it is risk on still, and that's totally fine. But what I'll call out here is the rounding off right here and how it could be potentially heading up. Notice how if it heads up, 2021's right around the corner. We talked about the seasonality chart, I think, on the last video, how February you see some drips or some pullbacks. So keep an eye on this. If we cross above 0, that could be the call for, hey, risk off right now. And that's what I'm trying to say. If there's some storm clouds, I can see them up ahead. Things could get, pretty rough in the very, very near future. And we don't know if that means a crash. But what Michael says so often is it shows that we have the conditions are there for a potential crash. So we need to position ourselves properly when these signals hit. And then we have the lumber to gold ratio right here. You see a little bit of a pullback. Lumber has been on a relentless tear, okay? Crazy, crazy stuff. So now we're looking at the 13-week rate of change. A little bit of a downtick here. You want to be risk off when we close below 0. So it can take some time to get down there, but just take note that we're seeing a little bit of a downtick so far, and it's only been 1 day of the week, just to remind you. Now, this is obviously through the ratio. When lumber does very good, that's showing us, or relative to gold, that's saying it's a risk on. When gold starts doing much better comparatively to lumber, that's kind of that risk off type move, okay? So let's look at commodities now. I'm going to just touch on a few things, get into the dollar. really quickly bonds, and then we're going to just wrap this all together, okay? CRB index, a widely tracked index of commodities, is a basket of commodities. Look at, they're saying that we're struggling to get inflation. Since November, the beginning of November, commodities, the CRB index is up 15.2%. That is a very strong move in the price of commodities. And I don't think that this is going to change dramatically in the near future, potentially. But I do think that this trend of this constant move up will probably continue here in commodities, given what the current monetary policy is. Then we have WTIC. You can see here from where it was in November to where we are right now, 37.8%. Yeah, I marked out this level of resistance of 50. If we start getting above that, be careful, because when you start seeing aggressive spikes in oil, I've said this many times, rising costs of oil have led to the last recessions in the last 40 years. So if we start seeing aggressive spikes, now mind you, this is still relatively low. There's no reason why we can't be poised to move to 70. I've shared that on my Twitter account. I shared a monthly chart of oil looking like, it's very strong so far for the month, and it just broke above a previous area of resistance. There's no reason why this can't go up to 70 in relatively quick period of time. I'm not saying that it will, but I am saying that it's poised to. Then we got gold. Gold, weird day. I mean, this is overall the commodity. Everything has been a weird day because we're trying to settle the news, digest the news around stimulus, about the Tesla being included into the S&P 500, about more lockdowns. We had the UK, go on lockdown. We have all this, everything just kind of going bonkers all around us right now. So look at these candles, like up, where do we tag? The upper resistance line, right? That can be the neckline of potentially this left shoulder, head, right shoulder. If we get above that, hey, we can start really going higher. But then we have this level, 1960, to crack above. Overall, we're still above the 50-period moving average. We're above this trend line of this breakout of the falling wedge. So things are good so far. But keep in mind, we also had a left shoulder here, a head, and then a right shoulder here. We came above, and then we had this rip down to the downside. I'm not saying that can happen again, but it's happened. So why couldn't it happen again and get this big pullback? Now, keep in mind, as we stay above the 200-period moving average right here, that means every day this goes higher and higher. That's the Godfather moving average, right? So that is telling me that it's in bullish context still. If we start getting closes below it and actually holds, not just like this little, quick little hit right here, maybe it's poised to move lower. Maybe 1750, it can go down there. We'll see. The trend right now, if you look overall from August, lower highs, lower lows. So until we change that, the trend in the intermediate term is still bearish. But the overall longer term, looking at the 200 and the 50, it's bullish. Well, 50 is kind of sloping down to trying to level out here, but the 200 is bullish. Then we got silver. Look, we marked out this area of resistance, and it looked like it definitely cleared it today, and I think we might have closed just above it. But it's never just a set number, a solid number. It's kind of a web of numbers. So it's in the vicinity of this resistance still. And on a good note, we're clear above the 50 period. We're clear above the breakout here. Now we're just running this to some resistance right here. Maybe we start clearing it and start hitting that 30. There'd be no problem hitting 30 if we start clearing now above this high of the day, which was 2750. So a lot of volatility in the metals today. And then we have Bitcoin. If we come get back tested, that would make sense to me. The 50 period sloping up, solid breakout, but it did get ahead of itself a little bit. So it needs to consolidate, could put out a bull flag. But if we start breaking below 22,000, then the next step is about 21.5. And then after that, we're coming down here to 20,000 again to retest this. If it holds there, great. If it doesn't, watch out, because if it starts breaking through those levels, we can see some aggressive selling even lower. But as I see it right now, this is just kind of consolidating or potentially rolling over to back test. And then we have to take it from where we see it at that particular point in time. If we start breaking above this previous high, so 24,000, about 24,500, then hey, that's poised to continue this big run here. Let's look at the dollar very quickly. This is very interesting, and I want to point this out. What do you know? The dollar was very, very strong on this falling wedge breakout today, and then equities were very, very, hit hard on this gap down. And first off, it tagged the 20-period moving average. That acted as resistance perfectly, and then we started moving down. So let's take note that the 20 periods holding. It took the dollar to collapse from 91 down to the low of the day, basically, to get a rally. Okay, so the dollar is telling us something here, and the equities market is. So, if the dollar is positioned to move higher here in the near future, equities are going to not have the greatest time dealing with that. Clearly, equities are only doing better when our dollar gets more and more devalued. So we might be making gains in the market, and we might see these unrealized paper wealth gains. But if our dollar is completely getting destroyed over time, where's the safe place to be? It's very hard to say. And then you have equity, or obviously commodities, so going up as well. So let's just be mindful. Still in a bullish pattern, not the greatest looking candle, and not the greatest day, as clear as just strong bullish momentum, and the bears step down. But on the weekly time frame, we're still here in a rising wedge. This is very interesting to me. So, we had the falling wedge here when it took, multiple weeks, February, March, April, May, August, just trending sideways, and then we broke out. So, hey, maybe we're setting up for something very similar or not. It's hard to say. I think that the dollar has, it's just overall very interesting right now, and we'll wrap that up in the conclusion. Let's look at bonds really quick. Bonds didn't do anything, really. I mean, we're up slightly. Red candle, moving sideways. It's been ping-ponging lower lows, lower highs. What is interesting is you're seeing equities really start to, this huge move, and you're not really seeing bonds take that big of a hit when they're kind of negatively correlated for the most part, not always. And then you look at yields. Yields have been just kind of just trending sideways. The 10-year, it's at 95, putting in higher lows, just drifting high, a little bit higher. So not much is going on right here, which is just interesting to see how, the dollar has been kind of just collapsing down, and stocks have been just kind of ripping higher. So just everything overall is just setting itself up, and I can clearly see that there's some storm clouds off in the distance here. All right, let's wrap it up with a conclusion. I don't have any charts for my conclusion, but what I want to kind of just bring home again is, first off, we saw a little bit of a weird glitchy thing that took place in the SPY today, where it printed a number up like at 378, and I don't have the chart on me, but 378 something. So that could be saying, hey, maybe the market wants to push us up there very soon, or it could be nothing. So take note of that little weird number there. And then two, the dollar, I want to make sure that everyone's eye is on the dollar. Clearly, when we saw strength in the dollar, equities had a huge hit. So the market right now is digesting all of this news. And overall, I mean, what did we see? Well, the market's basically flat for the day, but we saw a huge increase in volatility. So, you got to be the judge here. It's coming into the year's end. There's usually a big old Santa Claus rally, and then typically we get some, downwards and sideways momentum in January, and then based off seasonality, February usually gets hit hard on post-election years. My view is I am scaled back pretty significantly here. I've been in commodities. I've been long commodities for quite some time, basically since the March bottom. And I've just been playing on these. I plan on holding that stuff for a very long time, because I do think inflation is going to, the Fed is going to get its wish on inflation. It's going to constantly go higher and higher. And just judging by everything around me from the day-to-day perspective, I want everybody to know that, and you probably see it yourself, is everything around us is getting more and more expensive. So I'm positioned like that, mostly cash, and I did insure myself just a little bit with some on my long positions. And if there is a big market crash, yeah, geez, oh my goodness. I'd feel bad for a lot of people, but one of my insurance little plans here, and I don't want to talk specifically on what it is. I can tell you that it's a hedge position for some, it's just a long hedge position on some puts, small amounts, but if the market does roll over, that would print just a ridiculous amount. So you got to be very careful if you don't know option strategies or how to hedge long positions, but I feel quite comfortable being in cash. I feel quite comfortable being in commodities. I feel, good being on the sidelines while I'm kind of seeing this storm clouds brew. So hope that helps going into the end of the year. For everybody, happy holidays, Merry Christmas, Happy Hanukkah, everything and everything and everything. I will see everybody here on tomorrow's show. Goodbye.